go very short on how smart you think you are and very long on how little you know.
You are measuring money in tens of billions. How do you think about it?
I don't think I've got any edge from an alpha point of view in terms of making calls or geopolitics. Where I come at it from as a risk point of view is just thinking what scenarios might cause a problem in the future, where might we have assets, where we might not be able to get them back. You have to have clarity and simplicity.
I'm speaking about the LDI crisis. Liz Truss is now shifting blame on everyone.
The changes government put in place could have worked, but how LDI portfolios for DB pensions funds were structured turbocharged the challenges.
The actual risk event happened after the announcement of the so-called mini budget. Do you think it was the trigger?
Oh, I think it was a trigger, yeah.
What's been your biggest mistake?
Be mindful if you are going to be leaning into a systemic crisis and you are being short risk, that when it does turn, it can be savage. When the system is imperiled, the rules of the game can be rewritten. Be very careful if you're the wrong side of that.
Hello and welcome. It's Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My guest today is Richard Tomlinson, Chief Investment Officer at LPPI, Local Pension Partnership Investments. Hello, Richard. Very good to have you on the show.
Hi. Hi, Igor. Good. Thank you for having me.
So LPPI is not exactly a household name. Can you explain very briefly what it does? What purpose does it serve?
Yeah, so LPPI is one of the what's called in the UK one of the LGPS pools. So the LGPS is the municipal or local authority pension scheme, and the pools were created around about 10 years ago to aggregate assets and manage assets on behalf of the just under 90 local government pension scheme pools. There's about £450 billion of capital across the whole scheme, and LPPI manages assets currently just under £30 billion today, and will be going to nearer mid-50s, 55 billion, something like that, as of April 1.
So your purpose is actually to pay pensions.
Yeah, exactly. So as I say, the
As simple as that.
It is. It's pay pensions as they fall due, affordably and efficiently. Is the long-term mission.
But I think what is important here is that the purpose is not just to pay pensions. It's to pay pensions like for the decades ahead.
Yeah,
so
absolutely.
You need to think about your portfolio very long term. And another very serious thing is that it's a big portfolio. You are measuring money in tens of billions of pounds, and moving such a portfolio is not an easy feat. So how do you think about it?
Yeah, great question. Well, I think with, like all portfolio management, you start off, what are the objectives, goals, and what are the constraints? So long term, to go back to that mission piece, it's to pay all pensions as they fall due, efficiently, affordably. Then you have to work backwards from that, and as I'm sure you're aware, it's a defined benefit pension scheme. At least these things tend to be. So you've got to work out, since you look forward, what's the forward-looking liability profile? So you start from that, and then you work out how the capital you have today and the future contributions, and you do a little A&M study. And then you work backwards from that to find the way to essentially discharge those liabilities in the most efficient way. So we tend to think of it like a total life cycle approach. So as I say, it's that affordability point, efficiency point. So it's finding a way to build a portfolio that not only stays in the risk envelope, that enables you to find the right balance, let's say, between generating return on capital in the portfolio you have today, set against the risks of managing future contribution liability, if that makes sense, managing how much future cash flow has to come from the underlying employers and members to pay the pension promises.
At one point you wrote, in my mind, building portfolios that can cope with a range of plausible outcomes matters more than optimizing for a single view. When I read it, it resonated very strongly with me, because right now I am working on a book together with Frank Fabotz, Alex Rudin, and Andrew Chin about robust portfolio optimization. And I would love to hear your view. How do you think about it?
Yeah, great question. I think maybe a little bit of context. I grew up around hedge funds, spent most of my early career thinking about this. So maybe my framing is more in line with that, thinking through and managing uncertainty, and where do you get edge from? It's that kind of mindset where I'd come from. So don't bet the house on a single outcome. So certainly from our point of view, if you go back to that, you have a long dated liability profile, but even that's not certain, because the cash flows you have to meet are inflation linked. So you have risk and uncertainty around some of those things. You then have a lot of uncertainty as well in the future, discounting those liabilities. So then the model, we use an ALM model, which has, it's a stochastic type model, which tries to take into account different versions of the world, and stress things in that way. And then you work back to a series of asset allocations and portfolio allocations, let's say. So, and then within that, what we try not to do is to say, be too cute on the thematics or things like that. You try and think what's knowable and what's not, and be humble. And I quite often say, go very short on how smart you think you are, and very long on how little you know, or the things that are unknowable. And then think about what things are likely to be perpetual, which things are cyclical, or structural versus cyclical. And then think quite carefully about the regime you're in, because I think, just maybe segue slightly, just think carefully about correlation. Don't over rely on things like market optimizations. Yes, there's a whole list. You could take this conversation in multiple directions, but it's something we think deeply about.
But eventually, at any point in time, there must be some conviction in what you do in your portfolio, because you may only have one portfolio at any given point in time.
Yeah, absolutely. Yeah, and I think to me that then comes back to it. I think it comes back to being thoughtful about what you want to bet on, where you want to run risk, and that then comes back to what you think's knowable and where you might have confidence. So certainly, if I think about what we do, and I don't think we're that different to many others that look like us. You'd argue that you think quite long and hard about the long-term strategic allocation type thinking. What sort of risk factors or assets do you want exposure to? Think about how those might work out in different scenarios. So there's quite a lot of deep thought on that, and I've talked quite a lot recently about. I think we're in a period of change, and how do you think about resilience in the face of what is the role of the US dollar going forward, the financial system, real assets, duration, that kind of thing. But once you've done that big picture thinking and thought about that long horizon stuff, you then almost get back straight then down to the asset selection, manager selection piece. Almost then what we don't try and do is be too cute on the mid horizon type stuff, where you're making shorter term horizon calls on equities versus bonds or whatever it'll be. It's then you're into building a portfolio that has certain characteristics within the bigger picture exposures you've looked for. And I think if you look at where we would tend to take a view, we tend to congregate in the higher, in inverted commas, and you can see me, so higher quality assets and higher quality strategies in different areas. So we tend not to be trafficking in the highest risk areas of any given grouping or segmentation, however you want to think about it. And that's then linking back to the long-term mission and resilience of paying pensions and cash flows. And it's bringing that all together. So you have to build a portfolio, and obviously it's multidimensional in terms of what you're trying to think about, but it tends to be skewed in that direction. And there's the adaptive piece when you think about how you might evolve the portfolio. But we try not to be too cute at our level. You might then think about building things in the portfolio that have this adaptive nature, but it's up one level down. So the managers themselves will be doing that rather than us.
In other words, you think about possible disaster scenarios, and you need to make sure that your portfolio survives those disasters. You need to sail through all the ups and downs of the market. You need to survive pandemics, wars, and anything that is going to face us in the next few decades.
Yes, exactly. And that's our thinking again, because we have a portfolio that spans public and private markets. So the minute you have a material private market allocation, that isn't something you can move around quickly. So you have to think that through and how you frame that. But certainly our mindset would be that we're far too big, and it's not in our mandate to take a view where you're thinking short horizon. If you don't like the look of the world, you can liquidate and go to cash or some other risk-free position, if that makes sense. So absolutely, our mindset would be to build resilience. I think I often talk about, you build a portfolio that you hope you aim to perform well in expected central cases, and that's more than one, multiple cases, and survive plausible tail scenarios. Obviously, you can't plan for every scenario. There'll be some things you just can't plan for, because otherwise you can't take any risk. And even then, at that point, even defining what risk means in that context isn't always simple. But absolutely, it's again just thinking through what's knowable, what's not, and then trying to build portfolios that survive. You call it all weather, and are resilient, as you say, to pandemic, higher rates, lower rates, because ultimately it brings you back to the mission, which is paying all pensions as they fall due. And if I was to put a little bow on the top of how that you bring that together, you're trying to build a portfolio that has income or liquidity to pay pensions today, has cash available, but also then compounds capital to pay the pensions of the future. So you have to think about it from a dual perspective.
Okay, how do you combine your long-term vision and long-term purpose with frequent evaluation of your performance?
Yeah, that one's really challenging. And I think what I'd say on that, and this is the journey we've been on, that we are still on, and I look at where others are, it's an awful lot about stakeholder management. So if you talk to the sort of institutions with long history and who've been doing this for a very long time, you tend to see that they can stretch out their horizons of how performance is evaluated. So my chief executive spoke. I think I forget which one, but one of the large Canadians, the Canadian Maple 8, I forget which one it was, and they were talking about, oh, we don't look at anything less than, I forget what the number was, but it was a long time, and that's what we're benchmarked by. But that's like, well, I think that is the vision. But when you have stakeholders and you have accountability, it's quite hard because obviously the mission is that long horizon. But ultimately, you also need to manage your teams, your business, and your accountability in the shorter horizon. So it's a really difficult thing to do. I think what I would say is having absolute clarity on all the basics. What's the risk appetite, risk envelope? What's the mission? What things must we avoid? What are the core performance drivers? And one thing we've done more recently is we've developed a balanced scorecard. So it's 4 quadrants: absolute return, liabilities, returns, risk, real world outcomes. And it's bringing all of that together into something more balanced, because if you're not careful, like running hedge funds are similar, you end up having conversations where you get evaluated against things that aren't necessarily relevant, let's say, because there's white space. So it's having that clarity of defining what good looks like and then holding yourself to account against that. But it's really not simple. The time horizon one is difficult because ultimately it's a long horizon endeavor, but people want shorter horizon oversight for accountability.
Yeah, and don't you think that one of the problems here is that people may see some environment which looks scary, maybe the environment to which your portfolio is not very well positioned, you lose money, and they want changes, even though those changes will not necessarily go well with your long-term strategy?
It's always isn't it always the bias, whatever you want to call it, the bias to action, do something. And sometimes that's the right call, but at the time you're normally crashing straight into the behavioral biases that the night is always darkest before the dawn. So I'm very, very conscious of in my earlier career, I've made many of those mistakes, like many did, where you cut risk at just the wrong time, you flip from value to growth, or whichever you're looking at just the wrong time, because that's when markets are most stretched, whatever words you want to use. So it's trying to have that discipline, and the way I think about that is to try and do a plan forward and think about what are your beliefs, anchor to those, be very clear what you're doing. But there is always that, is now the time to switch, and be very clear on, if you are going to have risk management approach protocols, be very clear on upfront what they are and what you might do in different scenarios. So there's a whole series of things around that, but I'm certainly very conscious about the behavioral biases, and quite often you do exactly the wrong thing at exactly the wrong time, if that makes sense.
So how do you think about risk?
Multidimensionally would be the throwaway answer. I think it's very hard to. I'm definitely not in the camp of defining it in one dimension. Maybe there are some money management roles where you can define risk in one dimension, but that would then have to fit into the framework in which you operate. I can't think of an example of that. The throwaway volatility or something like that as anything useful other than in my mind. If we're talking portfolio volatility, I'll put a huge band of margin around it and say, look, if we're talking about a portfolio that is in the range of 5 to 10% volatility, that's one thing. So, for example, the multi-asset balanced portfolios we run, they're going to be in that range. They're not 2 or 3, and they're not 15 to 20. They're going to be in that 5 to 10. But I don't try and refine too much beyond that, because I think you get into all the challenges of that. It's useful as a marker point. But then I think what I'd say is, I think quantitative risk measures can be helpful in public markets where you've got some view. I think with some data you can work with. In private markets, it's really difficult because you end up using proxies and basis risks and that. But I think if you don't try and think about private markets in some form of risk framework, you then end up having this, frankly, being blunt, silly conversation that there's no volatility, and you have to start saying, well, there's economic volatility and there's accounting volatility, and which are we talking about here? Yeah, accounting volatility masks the economic volatility, and then you've got to start adjusting for leverage and other things embedded within private market structures. So I try and take a holistic view, use quantitative, qualitative, and then what you might call judgment, and just look through and think. And critically, the bit that I talked a lot about will be, what is the thing that knocks us out? For a hedge fund, for example, you have to manage quarterly returns or monthly returns because there are some numbers by which, if you hit them in a drawdown or on a number, it gets really hard to raise future capital. You told your current clients that we would never lose more than X in a month, so you have something very precise to work to. So from my point of view, it's working out really what are those pain points and where are the actual limits, rather than just coming up with a number that feels good, if that makes sense.
How do you think about geopolitical risks?
So being candid, I didn't think about it that much until a few years ago. And I'm not sure I'm that unusual. I think until a few years ago, I think you could probably say, unless it's driving the oil price or rates or inflation, most of the time it's noise, you can look through it. And I think there was a geopolitical order that you could kind of rely on. I talk about the world is playing nice, the rules-based order, everyone was optimizing for some derivative of efficiency or something like that. And at some point that started changing, and we can debate when that was. Was that 2018? Was it when Trump first came to power? When things started getting a bit more challenged with China? But I think the wake-up call for me was 2022, with Russia, Ukraine. That's when I really started paying attention, and I frankly went down the rabbit hole and did lots of readings, trying to educate myself more. And then you started thinking quite a lot more deeply about how this might play out. And I think it's becoming clearer to me that I don't think I've got any edge from an alpha point of view in terms of making calls on geopolitics. Where I come at it from as a risk point of view is just thinking, what scenarios might cause a problem in the future? Where might we have assets where you might not be able to get them back? Where you're worrying about return of capital, not return on capital. And then thinking how regime shift has changed. And I think there is a clear regime shift now. I don't think I'm saying particularly revolutionary here, that you're now in a, call it multipolar world, splintering world. And what's the role? The one things I think deeply about is the role of the US dollar, from the function of the financial system, and what you might get paid back in 10 years' time. Will a pound sterling be what it is today, or are you better off owning hard assets for the next decade? Because I don't know what I don't know, almost. So certainly a lot of things, but I'd say I think most people in my situation are thinking much more deeply about the big picture, framing the rules of the game, systemic type questions on macro and geopolitics now that you could probably take as a given 5-10 years ago.
You mentioned the role of the dollar and the sterling. Your liabilities are sterling liabilities. I presume a large part of your investments are in other currencies, and first of all, in the US dollar. How do you think about the currency risk? Do you do anything about it at all?
Yeah, we do. So our model is, again, I'm a believer in when you're operating at the scale we are, you have to keep things, you have to have clarity and simplicity, because we're a global multi-asset investor with a complex portfolio. So from an FX point of view, we look at each asset bucket as an asset grouping, and then we have a view on, is that something that would naturally be hedged or not? And at its simplest level, it's driven by, is this a real or a nominal asset? So I think we could probably have a long debate about, should you hedge global equities as a sterling-based investor? There's people who are probably far more expert than me on that, but I take a view that as a sterling-based investor today, you don't hedge your global equities, because even what are you hedging? Now, at the portfolio level, that's a different conversation. We'll come back to that in a second. So real assets that are international, unhedged. Nominal assets, say global bonds, absolutely fully hedged, because it's a nominal asset and you haven't got call it the earnings pass-through type approach, where the real earnings power or the real value of any asset changes. In nominal assets, that's different. And then you have things that I'd probably put in the middle, core infrastructure. I know we own a lot of core in equity, although it does have kind of hybrid characteristics. There's a bit of a debate there. But you have a hedging process at an asset class level. You then roll that up to total portfolio level. And then in our model, the current the end pension funds own that FX decision about how they want to run FX risk at the portfolio level. We give them advice on that, and we take an approach which we call it a strategic currency allocation. But in other words, come up with a long-term view of how much exposure you want to a basket of currencies, and then run an overlay to bring it in line with that. Not all our partner funds use that approach. Others are, I say unhedged, they're not unhedged. They have the natural hedging that rolls through from the underlying assets being hedged in line with what I just described.
Speaking about risks, let's remember one prominent risk episode which happened a few years ago, and I'm speaking about the LDI crisis. Liz Truss is now shifting blame on everyone and anyone, starting from the pension regulator to the Bank of England to the pension funds themselves. In your opinion, what did really happen at that time?
Yeah, and I think if you look at what was taking place, I think there's a whole series of things in terms of the functioning of UK markets. I think my view would be we can talk about fiscal crisis and bond markets taking place and all of that, and that's probably like a bond vigilante issue that's could happen anywhere. Not quite could happen anywhere, but is a sort of systemic issue. I think the UK was a special case with LDI in the sense that there were quite idiosyncratic things that took place in terms of the structure of the gilt market, who owned inflation-linked assets or gilts, whatever you want to, linkers, and then the structure of how DB pension funds owned them and how they were implemented with leverage and other things. My point would be that I think you had the changes government put in place could have worked if it wasn't. But the specific market microstructure structures of how LDI portfolios for DB pensions funds were structured essentially just turbocharged the challenges. And then you ended up having the proverbial elephant running at the mouse hole, which from my perspective, I'm not sure was an unknown. For a long time, I'd always sat there scratching my head. And I'm not an expert on LDI, I'll hold myself out. But just looking like who are the natural owners of long-dated UK inflation risk? It's UK DB pension funds because they're being told to buy it because they're incentivized to do that. I get the why. And then you go, well, you've got a one-way trade here. And I always thought, for what it's worth, that something might go wrong there, but I thought it would be a change to the regulations. I was worried that what would happen is if someone changed the rules that people were operating by, you could have this huge trade where people say, I was doing this, I don't want to do it anymore. And then you have this, as I say, the elephant running at the mouse hole. But it didn't quite play out that way. And obviously there's been some shape and form in terms of how LDI strategies are managed now. I don't think it was a bad idea, but there were some challenges with the implementation. But yeah, I think that has, whether was it a canary in the coal mine for what we might be facing more globally? Don't know. But I think there's an awful lot of focus on, call it fiscal sustainability and the long end of the yield curve. I think that's something. I don't think those challenges are going away anytime soon.
Yeah, but the actual risk event happened after the announcement of the so-called mini budget, right? When Liz Truss decided to get away with £65 billion of unfunded tax cuts. Do you think it was the trigger?
Oh, I think it was a trigger. Yeah, I think it was. I don't. Whilst we could all say it's almost impossible to, you read headlines on the Bloomberg saying markets have dropped by this, and someone's trying to link it together. I think there was a trigger there. But what was it? Could it have happened from something else? Could something else have triggered some of these things? I think so. I think that the preconditions were there for a problem. But that was the trigger that set things off. And then we're dealing, a complex adaptive system that was almost unforecastable how it would end up. And then you had, jump conditions, whatever words you want to use, and a wave of liquidation.
Okay. Now, you spoke a little bit about private assets in your portfolio. Why do you have them at all? It's so difficult to manage them. You need to put in so much more effort in managing private assets than public assets. And there have been plenty of papers showing that actually they're not bringing you any better return than public assets. So why?
Yeah, so interesting question. It's something, and to be candid, it's something we refine on a lot. I think there's a few reasons. One, I certainly haven't been in the camp. I've argued for a long time. I don't believe in buying private assets just because you think about the return kicker argument. If you just want to buy these assets because you think you're going to get a spread over the public, I think that's not necessarily the right reason. I know there was a push 10 years ago where many pension funds said we're underfunded, we've got to jack up our exposure to private equity. And maybe you'd argue that was a signal that was the turning point. Who knows? I would come at it from, there are certain things that you can do in private markets that you can't do in public. An obvious example is local investing, which is part of the LGPS. So we are the fit for the future pillars. So we are being required to invest locally. If we have new partner funds joining us in the southwest of England, it's going to be very difficult to do local investing, not privately there. So I think there's reasons you can do that. Or pure play in some asset groupings, if you want to take pure play exposure to certain themes, you can do it in the private markets. I'd also say that I'm unconvinced. I don't personally view it as quite as distinct as public and private. I think they're both accessories to underlying economic exposures. So you build a portfolio that you want to build. That so you have different kinds of governance rights, liquidity, and other things. So I think you have to take a multidimensional approach. I don't believe it's as simple as return kicker or illiquid or anything like that. And we're able to warehouse where the illiquidity, if that makes sense. I think if you're in a world where you have to provide liquidity on a systematic basis, say monthly or similar, I think it's quite difficult to do some of these things. I think we're trying to find solutions, but it is more challenging. So there's a whole different whole series of directions we could take this conversation, but certainly, I take a very balanced view. What I do reject is this idea that you have to own private assets because they're higher returning. I reject that. I've read much of the research that I think you're referring to, and once you adjust for, if you haircut liquidity or liquidity, whichever way you want to frame it, and leverage, then you get a slightly different result. There is for pension funds, there is and I'll quite happily say this, some people will point to volatility laundering.
Yes,
But
I would do. I would do that.
Yeah, and I think it's a fair challenge. I think for some institutions, depending on how your assets are structured and your liabilities are structured, it becomes a feature, not a bug, depending on how you frame it, in the sense of smoothing around valuation points, because it may be a more efficient way to stabilize your valuations at certain points than buying put options or similar things. So there's many ways to come with that. I think where you're naive is that sounds too assertive and arrogant. I think you're misguided if you think
I'll go with naive. That's all.
I think you're mildly misguided if you think that the printed volatility of private assets is reflective of a risk profile. Sorry, stupid computer's trying to shut me down. I'm so sorry. I think you are misguided if you aren't separating out the economic volatility, economic risk factors versus the accounting volatility. They are quite different things, and the accounting volatility tends to be very smoothed in private assets, but then you have this huge left tail that when it is recognised, you can get this very significant jump in the valuation. So very smart quants like you might be able to price that properly, but most people just look at the volatility, and I think I'm misguided by that.
Yeah. You mentioned one more interesting thing. You said you are required to invest locally. And don't you think that this is kind of moral hazard? Because your purpose, as we have agreed, is to pay pensions. And by investing locally, you are serving some other function, some social function. It has nothing to do with paying pensions. Basically, your pensioners are implicitly paying for this social function without even realizing it.
I think it's a nuanced argument on that. So this is obviously a huge debate in the UK, and it's happening elsewhere in Canada and other places. I think what the debate we're driving at is, how does national policy or local government policy interact with fiduciary responsibility? And then you have to map that back to where that fiduciary responsibility sits and with who. I think you then have to have a conversation around it varies by different groups of pensions, for example. So what I'd say is I often say this, you've essentially in the UK 3 groups. You've got defined contribution, you've got corporate defined benefit, and then you've got people like the LGPS and quasi-sovereigns. So the defined contributions are a very different conversation. I won't go near that. That's very different. It's my assets, and I could go live in Canada or America or elsewhere, and it's my money, and that's a different conversation. You're then relying on world worth living in type stuff. Corporate DB is, I've used, quite often say it's a risk management job, LDI, and that's a different conversation. LGPS does have a linkage back to the local economy because the contributions from the members are fixed, but it's the employers who will wear the variance or volatility in funding, and they tend to be locally based, and their income comes from local tax. So if you haven't got a local tax base, they've got nothing to tax. So you can make the line of sight argument in the LGPS specifically between having some degree of exposure to supporting local economies, local tax base, fiscal financial sustainability of the pension scheme, because as I'm sure you know, that the current valuation of a pension scheme takes into account future contributions that haven't yet been received. So your current financial position or fiscal position is based on future tax take, basically. So if there isn't future tax take, there can't be any contribution. So I think you can make that work, but I think the tension is real. And the bit where I come from, the bit I get nervous about, and I'm very vocal about, is not being open that there may well be a trade-off in terms of return. Because if you go for a pure, what you might call financial investor approach, you end up putting a local investment asset up against a global opportunity set. What's the probability you're going to do something like this when you really analyze the risks? You're probably going to say, I just can't do it because there's higher returns here, or I've got more diversification. And it could be a good investment, but it's probably not going to be as good as something I've got over here. Whereas if you reframe that specific mandate with the right framing that says, and I'll be quite precise, I'll often talk about a spread over gilt or something like that, like many others do. To think you're going to be doing these local investments with spreads of 500 or 600 basis points doesn't make any sense to me. Whereas you say we can then offset some of the social benefit and have a lower level of return hurdle rate, I think you can make sense. But again, that framing has to come from the top level of fiscal sustainability from the local tax base. If that makes sense.
Okay, understood. Yep, it does make sense. It's really a very interesting argument to have. But let's switch to another topic, which has been quite big recently: passive versus active.
Yeah.
Where is the on this?
Yeah, so the passive versus active debate. Hopefully, I'll repeat. I said I made this argument last week on a lot of different conversations. So hopefully, I'll repeat it as well here. What I think about it is, and I'm embarrassed I'm talking to a proper statistician, not me. So you'll probably correct me on my type 1, type 2 errors and that type of thing. But you've got to start from the risk mandate and what you're trying to do. So if you think about global equities, let's use equities as the case study. If you think about global equities, what are you trying to do in your equity portfolio? Are you trying to generate the optimal return from a fixed risk universe? So I don't want to miss anything. And I think that's a type 1 error, but you'll correct me if I'm wrong. It's error of omission versus error of commission type argument. So either I'm looking at a fixed universe and I want to exploit as many opportunities as I can, or am I coming bottom up and thinking I've got a long dated liability profile, I've got a set of investment beliefs, and I want to pick an asset portfolio that is well placed to meet that long dated portfolio. So this second one is more like the Buffett style. I just want to buy stuff that I love and I like and I know is well placed to what I want to achieve, versus I don't want to miss opportunities. So they're two different approaches. I think the top one is really quite hard as an active equity manager. You can argue for a quant framing. You might be able to look at things and model it. That does drive you more towards a passive approach from where we're coming from. The bottom up one, though, is quite a different framing, because then you're saying, I don't really mind. I might not mind that Nvidia's gone up loads, because if it doesn't fit in paying pensions and helping our risk profile, it is what it is. It's an error of, I don't mind. I'm happy to have errors of omission. What I want to avoid is errors of commission. So it's that kind of framing. So I think it comes back to mandate and accepting there is, the difference between risk and uncertainty. And I'll often talk to stakeholders about the investment management process. And I'll often say, this is a 51-49 game, 55-45, whatever you want to call it. So you're always going to have things and you've got uncertainty, and then you've got the hit rate of your investment calls, and you have to manage around that. So that's what I'm trying to get at, is that kind of framing when you come at that problem.
Don't you think about passive index investing as a kind of trend following strategy? Because the indices you're following are cap weighted, and in cap weighting, by definition, you are allocating more money to bigger companies. So if the company is growing bigger, then you are investing more in that company. So basically, it's a trend following strategy.
I agree. Yeah, it is, and I agree. And it's almost like I've had this debate for a little while, that if you think about a lot of large asset owners, a lot of people in our position have an equity portfolio somewhere between 40 and 60% of their total assets, something like that. And at the moment, if you're indexed against MSCI World or MSCI Acqui, you've got about 3% of the total portfolio level invested in NVIDIA on essentially a trend type approach because other people think it's a good idea. Now, it may be a great idea. It might keep going. It might not. But 2 or 3% of your total capital based on essentially other people think it's a good idea, you've got to try and think how that plays out long run from a risk concentration point of view. I'm not saying it's wrong, but just accept that for what it is. So I think I think if you're very mindful about indexing, and the bit where I get more, I've been quite vocal at times in the past, I will carry on, is that, I always joke about myself being a pretend quant. I'm not a proper quant, but I do know enough to know what I don't know. And then I worry that some other people put things in place and I can see the basic errors they're committing. So I get quite frustrated with some of the indexes people create, and you start looking at what's in them and you're like, how has that gone through a proper quantitative evaluation process? And I don't just mean back testing, I mean the whole, the stress testing, in sample, out sample, all that kind of stuff, which I know you'll do. And then people come up with these indices. And then you find that there was an example with a sustainable index last year, I won't name the provider, where I think the weighting for Microsoft moved from 6 points to 12 because there was some change at the back end of how a carbon footprint or similar. And you think, wow. So your actual exposure changed by doubled or halved. I forget which way around it was. And that, I don't know Microsoft. It's just, but that's the process that sits behind some of these things. It's the data sets. This is where I worry about that kind of indexing point. That passive isn't passive. Either pick something that is, if I'm honest, the argument I would make that the broad indices, MSCI World, MSCI Acqui, that's probably about as close as you can get to something as passive because there's as few active decisions as possible has gone into that. Once you move away from that, you're making many, many, many active decisions to how to create the portfolio. And who owns those decisions?
Yeah, absolutely. But as you mentioned yourself, when you're investing passively, you're still making those active decisions, but you do not realize that you are making them. You are delegating these active decisions implicitly to someone else.
Yeah, absolutely. And I'm not sure people even realize they're making those decisions, though, because I think people sometimes say, well, we want a passive exposure to this factor or that factor. And again, you're far more expert than I. But if you just simply take 5 people who are quite knowledgeable and ask them to find what value equity means, you'll get 5 completely different answers.
Yes,
it's
at best.
At best, yeah. Some people will talk about price to book, some people will talk about price to sales, some people talk about PE ratios, dividend yield. And then, so you get into the granularity and you try and design a value factor. You could have a value factor that could be completely uncorrelated with someone else's value factor. So that's what I mean. And you're taking very significant decisions on how you're implementing that. So it's far from simple. So that's where I come from. And I've almost gone full circle that I wonder where we're going in the future with greater complexity, where you end up going back to almost what I would probably call old school quant. You just simply say, I'll agree the manager and I'll agree the process of how you do your research, so proper institutional stuff, and I want exposure to these kind of buckets. Something that's some cheap stuff, some momentum stuff, some stuff that's growing, or whatever word you want to use. And then you build up your factor library and you assemble it in a certain way. At least I know what that is and I know who's accountable, as opposed to some other things. So I don't know. Question. I think it's interesting.
Okay, another big debate, in-house versus outsourced portfolio management.
Yeah, so again, it's something I'm quite happy to talk. I've talked quite a lot about this in the last few years. That I'll come at this from a, call me old school, but comparative advantage, risk, distinctive competency, what you're trying to achieve perspective. So I'm also I'd like to think I'm reasonably humble. I've made lots of mistakes over my career. So you try not to get over your skis and assume you can do something. So I'd come at this from think about it multidimensionally and say, well, what's our core business? What are we trying to achieve? Is this activity actually strategic to us? So it's really worth it. It's big and it's strategic, so it's worth us investing and getting right. And where do we have natural advantages as well? Because there are some things where you have a natural advantage, so why would you pay that away to someone else because you can do it yourself? But then there are many other things where if you do a detailed, call it a BCG, McKinsey style, MBA style analysis on it, you wouldn't do it yourself because you haven't got edge. It's not in your risk appetite. You're not big enough. Others can do it far better than you. So we kind of come at it from that example. The case study example I use is equities, where we do some equities in house. We call it quality compounding, Buffett style. Is it credible? We can do that. You can hire a team, some analysts. It's low turnover. You don't need trading firepower. You can kind of do that yourself if you get the right team and the right mindset, and you can be large enough to make it efficient. at the other end of the extreme, you've got the low latency HFT type world where, maybe you'll disagree. I think there's a small handful of people that can be competitive in that very specific thing, because the barriers to entry are big and you need to spend unknowable amounts on tech and trading infrastructure to be in the bleeding edge there. It's the D Shores, the Jane Streets, whoever. We're never going to do that. And you work backwards through those buckets about where could you. And at some point, you get into what I jokingly call the earnings guessing game, the short horizon equity piece. We can't compete with hedge funds on that, so you don't try. So that gives you the framing. It's just this bit's in our risk appetite and we can be credible, all of that stuff. So we'll outsource that. And then the other example I use from something I wouldn't want to do in-house, which I think captures it, is FX overlay. There are people who their whole business is optimized to do that. All their risk controls are in line with it. People have been doing it forever. The probability of them making a mistake on an FX overlay is very low, far lower than the probability of us making a mistake. Why would I do that in-house? I can outsource it for very little. And if you do make a mistake in-house, the notionals are huge. So you can end up with a very big portfolio problem if you get it wrong. So why would you do that in-house? So it's some combination of that framing, but we have a start point to outsource, and then you only bring things in-house where it meets those criteria of serving stakeholders, basically, including shareholders and fund participants.
Okay, but it's quite interesting you're saying this, because first of all, we know that there are large pension funds who insource some portfolio management and who are building strategies of hedge fund style. And actually, when you have $50 billion under management and you now have more, you can afford quite a lot. You can afford first-class infrastructure. You can afford first-class teams. And if you are able to build long-term plans, you're not saying that, okay, I'm just going to do it now because now it's fashionable. You're saying, I'm going to do it for the next 20 years, for the next 30 years. And you are building your organization to manage those things in-house. As I said, there are people who are doing this. And you have enough money under management to do that. Why not?
I think we will do that in certain places, but it needs to be a large part of the portfolio that moves the needle at the portfolio level. So it needs to be something where, again, it's large enough to move the portfolio, move the needle at the portfolio level and serve our stakeholders, which means our underlying pension funds. So we insource direct infrastructure where part of what you need is to be big. So why would you pay away that scale to someone else? And we bring that in-house. We're able, because we only do it in the UK and we're doing core, it's more about buy well, and then it's a stewardship activity, as opposed to some other areas in the private markets where it's, buy something and then invest and change. It's a very different investment process. I think for end asset owners like us as well, you have to be mindful about, candidly, the sort of shape and form of how you can pay people. And some of those other activities, it's not possible to really structure the compensation in a way that aligns with our mission. However, you say, so you would work with outsourced partners, and that's maybe private equity. And I'll say private equity, I'm always quite skeptical anyway. It's not something I had any desire to do in-house for multiple reasons. The business activity, how you need to pay people, what you need to get done, that doesn't make much sense to me. But there are other areas, say the hedge fund piece, where you could insource it. But again, you then start getting into quite often the secret sauce of what you need is quite difficult. It changes. There are an awful lot of reasons why I'd be quite skeptical. The one area where I've thought about before, and I could see people potentially doing more, would be if you were to do some of the easier quant stuff, whether that was the more generic type of things, if you wanted to do some of those in-house. But even those aren't that easy to get right, because as we talked on earlier, it's not just a simple of create a basic trend following model and off you go. There's a lot more to it than that. So I think you have to be quite careful about that. And not least, the management overhead. Hiring ambitious and driven people and maintaining them isn't easy.
It's not. Speaking about this, how do you approach managing investment teams?
Yeah, so managing investment teams is, I'd call it, is it an art form? No, it's one of those things that's probably, I think, I've used the phrase, it's simple but not easy. I'd say that in terms of the simple bit, it's create a good culture, have clarity on the mandate, have clarity on your investment beliefs and principles, and hire good people, try and maintain them, treat them well, create the right environment for them to thrive, take away as many pain points as you can, understand the different regimes that you operate within. So, for example, and what I mean by that is the difference between normal calm markets and stress markets. So, how your governance is going to work in each, and at what points might the CIA step in and become more of a risk manager versus delegation. So, it's all that kind of stuff. But I think to me, it's then also actually defining what sort of CIO you want to be, because there are some CIO roles where you are basically chief head, your head fund manager, and you're taking all the material risk decisions. There are others where it's more delegated leadership, and your job is to set the big picture vision, have ownership of the overall risk mandate and envelope and performance, but ultimately you're very heavily reliant on teams that report to you. I'm certainly in the latter camp. I've got a relatively big team, it's nearly 70 people now. And I'm extremely reliant on my direct reports and their direct reports and similar. I think you evolve, don't you? I don't think anybody starts off as a finished article. I think if I talk about my journey as an investor, I can't be the only person that very early on did some quant research or similar and then basically thought I'd solved the solution. They realized I just invented a perpetual motion machine, that my model had access to future data or whatever it was. So, I think when you're young, you have this wild confidence on how smart you are. And as you get older, you realize how much you don't know. There are loads of really smart people. The markets humble you almost every day. And then you sort of evolve. I think I evolved through, making lots of mistakes, lots of learning, working for some very, very smart people. One of the gifts I've had in my career is by virtue of, I spent many years at Auburn. I got to meet many of the greats, the people who are some of the smartest people in hedge funds and similar. And then what you often found is quite often the more successful and smart they were, the more humble they were and approachable and just very, we'll do this, we'll do it this way. So I learned from a lot of people, saw lots of different businesses, how they operated, how they run their investment teams. And and then you evolve. And so where I sit today, I also read a lot actually in terms of how you run teams and thinking on investment strategy and leadership and getting performance out of people. So it's a whole series of those things. But to me, in the context I'm in today, the settling is if you can build a strong culture, people who want to be part of the mission and act in a high integrity way, and they can express that through how they manage our partner funds portfolios. My view is, and when in a good, strong governance structure with leadership and clarity of goals, that is essentially the overarching philosophy. But it's been formed from many mistakes and learning from many smart people along the way.
Since you mentioned Auburn, I can't help but asking a question about the consultant market landscape in the UK. The recent changes in the pension legislation and the concentration of assets under LGPS, do these changes lead to diminishing role of pension fund consultants in the UK?
I think it's evolving. I think you could probably say that the concentration of assets into larger pools changes what investment consultants might do. The changes that are taking place in the defined benefit pension fund market as well, as you could say that as funds are de-risking or going to buyout, there's less for consultants to do. But what I'd say is I think it's evolving rather than disappearing. I certainly look how we work with consultants in various places, investment consultants, and have done for years. I think it's a little bit different in the way we've worked with them to maybe some others in the LGPS, in the sense that we work with them on, as I'll call it, the extension of staff type model, where there's things that we could do them ourselves or we don't have the specialist knowledge maybe. So we just lean on someone else's scale or platform or specialist knowledge to get something done. So I think that role is not going anywhere, where it's just not efficient to build a team of people to do this or that because it's a small part of what you do. What is changing in the LGPS is the investment advice bit, which I think there's lots of activity that needs to be done. What might change is the who does different bits and pieces, but I don't think near term the consultants in the UK, in the LGPS, certainly aren't going anywhere. They're just morphing in how they work. And I think what I'm seeing is they're focusing on different things and they're focusing more on partnering with the pools as that work product changes. So my personal view, I've always thought the consulting model is there's an element of advice where it's that kind of intellectual piece, but a massive chunk of it is simply an outsourced partner where they have scale or expertise to do something that you don't. And it's more efficient to work with them to do that. That was certainly an approach we, Allborn and others, from my experience.
All right. And my final question to you, what's been your biggest mistake so far?
Where do I start?
I don't know.
Yeah, no. I think most people, if you're senior, you're gonna have a lot of scar tissue. What would I say? I think early on I'd say overestimating my intelligence, thinking I knew something that where you can get edge from. And maybe there was a point 20, 25 years ago when I started that you could find edge in certain places, but it seems to have got harder and harder. So I think there's definitely that humility piece. Something I talk about, that a mistake I made that I've learned from, which I use this as an example. I think I learned a lot, that for those that were old enough to have, well, so I started my career in early 2000s, but so I was the GFC. I left Old Mutual in early 2008. So one slightly comical thing was that we were unwinding quite a large equity book in I think it was the first or second week of January, which at the time we didn't realize why markets were so crazy, but it was Soc Gen were winding down during QVL book at the same time. So we were like, what's going on? And yeah, only after the event did we realize. But I left it just after that. And then I had the bright idea of trading my own money. So I
Good time.
well, it was great. I had all the bearish positioning on. I left. I've been talking to lots of credit traders. I thought the world was really ugly in the summer. Had all the bearish positioning going on, and probably a lot of luck. I did really well in September. For whatever reason, loads of puts, whatever. Made a load of money. Great. It was highly levered. All my net worth highly levered. Great. What I didn't understand was in times of crisis, the importance of understanding how the system evolves and how the rules can be rewritten. So I made a load in the latter part of 08, gave it all back once markets turned, but was it March, April? S&P hit 666, gave it all back, ended up being flat kind of May to May, 08 to 09. And what I learned was one of the most powerful lessons was that when the system or governments is imperiled, the rules of the game can be rewritten, and be very careful if you're the wrong side of that. You can call it, the money printing starts, the plunge protection team, whatever framing you want to give. But if you think about it, the incentives in the system are to protect the downside, and in reality inflate away the value of nominal assets, and not take the pain today. So if you go through all of that, it helps them frame your big picture, long-term view of how you might think the world might play out. And as I say, for the 2000 example, it was that understanding that I would argue that the global financial system was bankrupt, i.e. its liabilities were greater than its assets. So what do? You just change the framing. Oh, we'll change how we value your assets. We'll change which book we put them in. Oh, okay. And then a load of other stuff as well. And so I lent heavily on this during COVID. When we were coming into COVID, and it became clear that this was so big that this wasn't going to be a standby and the world just evaporates. Something would happen. That's not to be silly about it when markets are going down, and don't risk manage. I'm not saying that, but be mindful if you are going to be leaning into a systemic crisis and you are being short risk, that when it does turn, it can be savage because the rules of the game can be rewritten. That was my biggest, it's probably pain point, and then learning of how to mature, I think, as an investment manager to say, be careful if you're going to push against these things. So.
All right, Richard, thank you so much. You have managed to squeeze so much wisdom into so little time. It's just amazing. Thanks a lot.
Thank you, Igor. Thank you very much.